So in this module, we're going to talk about your balance sheet in a lot of owners' situations. And please do not feel like, you're in a void with this. Most owners don't pay attention to their balance sheet, so it's okay. But a transaction typically is going to be cash-free and debt-free. So on your balance sheet, your cash will be there. You need to understand that 95% of the transactions, you're going to keep all the cash that's in your bank. So that's going to be a real positive for you. But now, all the debt's got to be paid off also. So in some businesses, you may be now looking at your profit margin was $1 million. Let's say you've got a 5x multiple for your business vertical. That's $5 million as a possible transaction, but you got $4 million of debt. Well, if you got $4 million of debt and you got to pay the debt off, then you've got $1 million left over. The only thing that you have to think about here is that maybe it's more valuable to do the transaction to get rid of the debt than it is to have the cash. Don't know. I'm just telling you that the transaction will have to be cash-free and debt-free. Now, another item that impacts this is your inventory. In a lot of businesses, inventory is expensed on the P&L. And that's okay on a day-to-day basis because most owners are operating from a cash basis. But from a valuation standpoint, if you've got $500,000 of inventory that's sitting on your shelves or in your warehouses that you've already expensed on the P&L, we can actually move that $500,000 of inventory over to your balance sheet, and it increases your profit statement $500,000. Now, it doesn't take a rocket scientist to figure out that if I'm on a 5 multiple, that's $2.5 million to you as the owner. So it's a real valuable transition. Now, obviously, if you've moved the inventory to your balance sheet, when you use that inventory to supply a customer or a sell, now it's got to hit the P&L on your cost of goods. So these are a little tiny things that we can do as we move through this. You're going to end up at the end of the transaction with a calculation called working capital. I introduce it to you because it's a very confusing concept for a business owner. Most business owners all look at that as the cash that's going to be left over in the bank to be able to work the business, and it's not. What it is it is a balance sheet valuation. Less the cash, less the debt, assets versus liabilities. And let's say that you have a balance sheet that has, for simple terms, $100,000 of value. When you close your transaction, your balance sheet wants to show the same strength. If you've increased the strength to $150,000, the buyer is now going to pay you an additional $50,000. If you've weakened the balance sheet by $50,000, you're going to lose $50,000 at the time of the transaction. So working capital is a non-cash item that affects the balance sheet and the closing of your transaction. We will do more work on this together as we move forward. But I like introducing the concept now because it's a foreign concept to all small and mid-size owners, but yet it's one that impacts the transaction. If you never stop operating the business differently, meaning don't start doing different things, expediting your collections or your payables, things of this nature, then you never have to worry about working capital. Because working capital will always end up being exactly what it was before. So it's a very fair item to keep owners in check. It keeps them from ramping things up over excessively or decreasing the value of the balance sheet. So 2 other items that will be on your balance sheet potentially is going to be one that we call the CapEx. The CapEx is the stuff that you have to spend every year to be able to put into either equipment or supplies or things that are needed to sustain the business. So typically, if a business has $250,000 of CapEx, you're not going to be paid on the value of that. That $250,000 will come off the transaction value because the new owner is going to have to continue putting CapEx out for the operation of the business. Another one is your real estate. Now, this is a really good opportunity, and we see in most owners that they own their real estate and they're renting the real estate back to the business. Now, this is a very good position for you as an owner because 99% of the buyers don't want to buy your property. They want to go into a long-term lease with you. However, the caution to the wind is this. If you're not paying yourself fair market value, meaning you're paying yourself $5,000 of rent, but fair market value is $10,000 of rent, well, the new buyer's going to have to pay $10,000 of rent. Therefore, they're going to reduce your profit by an additional $5,000 a month. Well, again, that's $60,000 on the year. At a 5 multiple, that's $300,000. So if you're not paying yourself market rent today, start paying yourself market rent. And if you don't have a functional triple net lease in place, obviously it's just between you and your own company, so it's not a big deal, but get one in place because it's going to be one of the first things that's asked for. So real estate's very important. CapEx is important, working capital, and remember the transaction will be cash-free and debt-free.